There's the closing bell on Wall Street, and now it's market domination overtime. Let's start with the major averages here because we definitely saw selling into the close once again here. Market's not holding on to gains, so the Dow ending the day lower by about 193 points, 0.4%. The S&P 500 down 1.6%. And so now looking at this 5-day slide that amounts to more than 4%. The NASDAQ doing the worst of the three major averages. Look at that slide over the past 5 days, 7%. And on this single session, nearly 3% as we saw the slide into the close. Now, the leg downward that happened late in the day seemed to be catalyzed by some comments from President Trump that there could be an additional 10% in tariffs on China. That's on top of the 10% that went into effect earlier in the month. He also reiterated this morning that those 25% tariffs are going to go into effect next week on Canada and Mexico. A lot of market participants have sort of shrugged off that those tariffs are going to go into effect. So whether this is real concern that they're going to go into an effect or just sort of a momentum downward and broad growth concerns kind of remains to be seen here. If you look at the groups that are doing the worst in the S&P 500 on the day, you've got tech really dragging down the other sectors, down by 3.6%. Utilities also taking it on the chin, in part because of some negative earnings within there. And within tech, of course, we got to look at what happened with NVIDIA shares really picking up steam to the downside as the day went on. Even though, as Josh and I discussed earlier, analysts broadly thought the results were pretty good here. Maybe it's just that they are not beating by the same magnitude that they had been in recent quarters. But this is the worst reaction to earnings going back at least a year for NVIDIA with that 8.5% slide. If you look at the selling, it was pretty spread out. Apple down, Amazon down, Microsoft, Alphabet, and Meta. Broadcom also down quite a bit with NVIDIA. These concerns, not just about China tariffs, but that there would be an increase in Chinese export controls that would hurt profitability of these companies. Also a concern. Tesla continuing its sell-off as well. Those shares down 3% on the day. And we have been tracking the Tesla selling that's been happening. The stock peaked back on December 17th. Since then, down by 40%. Even, coming back pretty much the levels where it was right after the election. So a lot of selling today continuing. Josh.
All right, Julie. Tariff concerns spooking markets today, plus concerns about the health of the economy also weighing on investors. And the recent decline in consumer confidence could mean more bad news. According to our next guest, joining us now is Mark Malek, Siebert CIO. Mark, always good to see you.
Thank you.
So let's talk. Julie was just mentioning tariffs. President Trump likes tariffs, Mark. He's a fan of tariffs. He was talking tough today, saying, listen, those tariffs on Canada and Mexico, they're gonna proceed as planned. He mentioned this additional 10% levy on China. I'm just curious how, as an investor strategist, you try to think through that. We've had other investors come on, Mark, and sort of suggest they almost kind of look through it. In other words, it's tough talk. It's a lot of huffing and puffing, but I guess they kind of see it as just one giant negotiating tool. Is that how you see it?
Well, it's how we try to see it, but it's becoming increasingly difficult. And it's not necessarily the tariffs themselves as much as the disinformation around the tariffs, the unknowns about whether they're actually going to go into effect, how much they're going to be, if they're going to last. And I think that information, that sort of fog of unknowns, it just is overshadowing just about everything. It's very difficult even for the well-trained investor to look past this and say, hey, when is pen going to be put to paper? What do these look like? It would almost be good, even if they're large, if we knew what they were going to be, then we could start to factor them into our models. But at this stage, we don't know what's going to be and what's not going to be, and that's really got everybody a little bit on edge, and it's basically applying some weight to the whole market at this point.
I mean, it's hard for companies too, right? We were looking at some Bloomberg data that was tallying up the number of mentions of tariffs on conference calls. It's at a record. It's around 700.
Yeah.
It spiked the last time there was all this talk, but it's spiked even more now. And how much does that have the capacity to weigh on decision making at companies and therefore weigh on earnings potentially going forward?
Oh, it sure does. I saw that same graph earlier, and those numbers are rivaling 2018 numbers, and we definitely saw companies having impact, making decisions based on what might happen. That's the job of management to anticipate these types of things. I think the challenge is again, if we knew what they were, if the companies knew what they were, because now we're talking about a VAT tax and a VAT tax versus a tariff, and I think, at the end of the day, it's all kind of negative, but how negative and where that impacts the companies and their decisions, knowing more would help. And I think knowing very little at this point is getting more challenging.
So it's uncertainty for the company and the CEO, Mark. It's also another uncertainty for the consumer, of course. We got a consumer confidence report this week. We had another strategist on the show. I think he used the word stinker. Is how he put it. What do you think as a strategist? You see these sentiment surveys coming out.
Yeah, this consumer confidence is the ultimate leading indicator of how the economy is going to perform, right? Because consumers have to consume in order to grow the economy, and consumption is 2/3 of the economy. And so if consumers are not confident, if they're afraid of what their jobs are going to be like, or if they're afraid that they're going to have no control over costs and things like that, they're going to consume less, plain and simple. I mean, if you look at the consumer confidence number going back many, many years, you could see that it clearly decreases before major recessions. So seeing that number is a little bit of an eye-opener. We saw it in the Michigan number earlier in the month, and it really, stinker is a good word for it. Mm-hmm. It was a stinker, and I think if people ignore it, they do it at their own peril at this point.
So what do you do as an investor? I mean, you've just been talking about the challenge of there's so much indecision. So as you try and wait to figure out what's going to show, and this seems to be a theme that's emerging. We're talking to a lot of investors who are saying, it's really hard right now.
Yeah.
Where do you position yourself in the meantime?
It's very challenging. We believe, from a long-term perspective, we're still very, very bullish. I think there's a lot of very positive signals coming from the economy. We had I believe, very positive earnings season, which is not quite over, but we've had some very positive signals. But the near term, this fog that's on the road right now, I think is having us pause and maybe saying, maybe we should, sort of watch things for a little bit. So near term, I would say we're still bullish, but I think we have to be very careful here because there's just, so many, there's a lot of tension, underlying the market. We're just underneath, all-time highs. There are a lot of, clearly overpriced things which can still go up, but you're not going to take that shot if you feel like some craziness is going to happen in the next couple of months. I think things are not going to calm down until at least next quarter. I think then we'll hopefully have a better view of what the sort of mid to long term is going to be like.
Mark, what do you make of the move we've seen in the bond market? I'm looking at the 10-year, the benchmark. We're back down to 4.3, Mark. What do you make of that? What explains that move? Where do you see that headed from here?
Yeah, I mean, listen, it's good that the 10-year yields are coming down. I think that helps certain sectors for sure. I think that could be a positive for the market. I know that the administration would like to see the yields lower, and for good reason, because it would be very stimulative to the economy, especially in real estate. But this is maybe not necessarily the way we want to get it there, right? The yields are coming down because of increasing fears of what's going to happen with the economy. Now, again, a positive, but caused by what I think is a negative.
Mark, always great to see you and to see you on set. Thank you for joining us.
Great to be here. Thanks so much.
Turning now to shares of Dell Technologies as its fourth quarter results just now hitting the wire. Let's get to those numbers. Q4 adjusted EPS 268. The street was at 253, so that is a beat. I'm looking at Q4 total revenue. That clocks in at $23.93 billion. The street was actually closer to $24.65 billion. In terms of what they see ahead, they see Q1 revenue, Julie, they're calling for between 22.5 to 23.5 billion. The street was at 23.55 billion. And for the year, it looks like they're calling for 2026 revenue between 101 to 105 billion. Analysts on the street, it looks like had penciled in about 103 billion. Some capital return news as well. It looks like the board does okay a $10 billion increase in that share buyback authorization.
And investors don't know what to do with this, right? Initially, we had the stock going down pretty sharply. Now it is taking a leg up, maybe on that cash return as investors are reading through and got to that headline. Kind of unclear what has been going on there. And this stock, it did relatively well for most of last year and then kind of slid a little bit, but it's still up 18% over the last year. And the company in the release talking about last year being, or its fiscal 25 being a transformative year here. Dell sort of getting caught up in the AI trade as well in terms of providing servers for some of those data centers. Maybe again it is that dividend going up by 18% that is helping cushion the blow of what looks like to be a revenue forecast that is a little bit short.
Yeah, I do see a headline here that the COO does say the AI server backlog at the company, roughly $9 billion as of today. And of course, a lot of folks have thought of Dell as a new way to play that AI trade. It'll be more interesting to see whatever commentary you get on that AI business, the AI server business. Shipments, backlog, margins, What are they seeing there? It was interesting because we had some analysts and we talked about this heading into this print. They were a little bit more nervous about this AI server business because they were talking about supply chain constraints. It'll be interesting what the execs have to say on the call about that.
Yeah, unclear if that $9 billion is a new number. It's Jeff Clark, who's the CEO, who's making those comments in the release. He said the deals we've booked with XAI and others put our AI server backlog at that $9 billion. So we'll dig into that and see what the analyst reaction is.
Yeah, you want more color on the PC market too. That's always front and center here. Consumer sales, corporate sales. Also, I'm just very curious what they have to say about the competitive landscape.
Yes.
We know what a rough year it has been for rival server maker Supermicro.
Yes, definitely.
All right, coming up, we're going to get you the latest earnings results from HP Inc. As those results are just crossing the wire as well. Stick around. Much more market domination overtime coming up.
Snowflake saw shares pop today as it projected better than expected revenue growth. That company also expanding its AI footprint with the new Silicon Valley AI hub and a $200 million investment in next-gen startups. On the flip side of that software space, we've got Salesforce providing fiscal year revenue guidance below Wall Street's expectations. That company expecting its new AI product Agentforce to make a modest contribution to revenue this year. Those shares fell 4%. So here to sort through software's uneven AI boost, let's get to Wolfe Research Managing Director and Head of Software Research, IXIC, who happens to be happily for us in town today and in our studio. Thanks for being here.
Thanks for having me.
So I guess, first of all, just big picture, how should we be thinking about the software landscape right now and the AI effect? Because it does feel sort of lumpy, for lack of a better word.
I think when you think about software right now, there's a lot of uncertainty in the air. I think for investors and quite frankly for customers, how is AI going to be monetized? How is it going to add value? How is it going to translate into incremental dollars? How does each company differentiate their AI solution? You hear everybody talking about agents, but it's unclear what the difference is between one agent versus the other. I'm a perpetual optimist. I think this is the best time to cover software because I think that a lot of these innovations are going to expand the markets, the addressable opportunities. I think there's going to be a lot of jobs that are changed foundationally and fundamentally, but ultimately there's going to be more digitization of labor, of workflows, of data that lead to better outcomes. And I think that the real value for these companies is that they understand the businesses of their customers. They have the data model and they can put AI in context to unlock that value in a secure, cohesive way that doesn't introduce new business risk.
Let's talk about some specific names, Alex, in your coverage universe. Salesforce reported they offered, I saw what's being described as a tepid outlook. But I'm just curious to get your take on that report and why you're telling clients this one's still a buy.
Yeah, I am. Look, I think right now, given all of the headlines around the macroeconomic environment, around the geopolitical environment, even for Salesforce, which just went through some management transition where they have a new, what they're calling COFO, COO/CFO, I think it's prudent to embed conservatism. It's a little bit of an uncertain world. And I think that when companies enter into a Q1 after usually what I would describe as a little bit of a hyper-seasonal Q4 period, it's good to inject that conservatism. Investors want a beat and raise story, and I think that's what Salesforce is positioning themselves to be for the duration of 2025 with this conservative outlook.
I guess the question is, if we are in a more uncertain macro environment, even potentially a slowing macro environment, presumably companies are going to want to save money. And I guess then the question becomes for these enterprise software companies, can they make that value proposition sale to these companies? Can they go to them and say, we can make you more efficient, we can save you money, even if you're spending money with us? Can a company like Salesforce successfully make that argument right now?
I think they can. I think they've spent the last, call it really 2 to 3 years getting fit. I think a lot of the companies in the enterprise software space went through really their first cycle where they had to go, where customers looked at their software spend and they looked at what was being used and what wasn't being used, and they started to rationalize. You've seen companies invent new words like platformization, and that's a term that basically means let me look at what I'm using, what I'm not using. I had everybody have a license for everything. Now I need to really take a really hard glance at what am I getting value out of. We're on the other side of that. And I think now for some companies that can provide both breadth, depth, and a strategic outcome for their customers, there's an opportunity to do more with them. And there's an opportunity for them to offer more value-added services in the form of agents, in the form of AI, in the form of these data products that can unlock that value.
I was talking to another financial analyst covers some of these same names, colleague of yours on the street. And we were funny because when I asked him about AI agents, he said to me, my eyes glaze over when I heard AI agents, which was interesting. And I'm just curious, as a financial analyst, how do you try to distinguish, okay, you hear AI agent, what's between what is real and what is marketing fluff at this point?
I think we're in a world where you have to try things, and it's hard to price and effectively promise certain or make commitments on certain amounts of revenue when we're in that trial phase. I think that this technology is moving extraordinarily quickly, and I think this year is the year that a lot of these companies start to actually show value. So remember, Salesforce, when they guided for the year, and they were asked many times about Agentforce, they said it would be a modest contribution. Now I asked about the definition of modesty. And it's beauty's in the eye of the beholder, but I would argue this year is the year that you start to see companies really put this stuff into production and unlock some value. And what that means is probably a point, maybe a little bit more than a point, maybe a little bit less than a point of incremental value, incremental bookings for these companies that are charging for it. And you're seeing some companies kind of maybe offer some of this functionality for free, get it in the hands of their constituents before they really try to turn on the monetization engine, which is another very logical outcome. People don't want to get into a situation where they're overpricing and under-delivering. There are some companies that, you would argue are suffering a little bit from that first mover advantage in the enterprise space. So I think it's prudent to be a little bit careful at this point in time.
I mean, investors are being careful. They're not yet buying in. I mean, you look at Snowflake, for example, which, yes, rose on its earnings, but the stock is down like 25% over the past year. So if your thesis is correct, I guess the next question is like, when are the investors going to come? Are they waiting for this initial discount period of the product to then get in?
I think for a company like Snowflake, you look at the consumption names and you've effectively been dealing with this. Are they an AI winner? Are they an AI loser? Does AI even matter? And I think, look, at the end of the day, it's a question about growth rates. There's not that many companies at all, but in the enterprise software space that have the capability to grow high 20s or 30%. That's really the opportunity that we see with Snowflake, which is why we recommend it to our clients here. We think that if they can show that the spend intensity on what they're selling is improved, because companies went through a little bit of a fog of war where they didn't know how to spend on the right platforms given all the changes that were coming with AI. Now they do. And now they're resuming their spend. They're looking at unlocking incremental value of their data within the confines of the enterprise estate. One of the most important announcements Snowflake made was the announcement with Microsoft, where you can now manipulate OpenAI models directly inside of your Snowflake instance at the same time as you can also use models from Anthropic. Not a lot of companies have the opportunity to offer that service at the same time. And so we think that you're looking at probably the second half of this year when some of this re-acceleration really happens. Q1's always a tough quarter for enterprise software. It's usually, even when there aren't as many geopolitical and headlines about the macro, a period of just figuring it out. So I would anticipate it's the second half. You saw this same movie last year, right, where software ripped at the end of the year, and then it underperformed through May or June, and then it ripped again. And I would anticipate a similar seasonality from an investor participation perspective. They want to make sure that we're not in a head fake, and that Q4 and the improvements that we saw in the second half of last year were not one time only. I think they want to see that durability, and so as you get Q1 reports, as you get more CEOs better understanding the environment that we're in, I think we're going to see a better landscape.
Alex, really helpful stuff. Thank you so much.
Thank you,
Good
guys.
to see you in person. We got to get to some more earnings here. HP Inc. crossing the wire moments ago. The share's not moving much, even as revenue beat expectations. It looks like the second quarter forecast is short of estimates. So let me run through it here. Net revenue in the quarter at $13.5 billion here. That was up just 2.4%. It looks like from the prior year. The company says earnings per share in the first quarter coming in at 74 cents. That is bang in line with analyst estimates. For the second quarter, adjusted earnings per share are going to be 75 to 85 cents. Analysts had been looking for the upper end of that, so that perhaps a little bit disappointing here. And the company, I guess that is that forecast here for the full year, is unchanged as well. So, maybe investors not very excited about this report.
I see CEO Enrique Lores out with a statement, talks about pleased with the Q1 performance, achieving revenue growth for the first straight quarter, he says, advancing our strategy to lead the future of work. Talks about strong commercial business and personal systems, momentum in growth areas, including, he calls out AI PCs. It'll be, always interesting to get his take on just the PC market. What's the trajectory look like to Enrique Lores? Consumer, commercial, pricing, and of course,
tariffs.
Printing, ink and toner, always critical for this company, right?
Sorry for my tariffs interjection.
Yes,
I'm just yelling tariffs randomly throughout the day because it's on everyone's
You'll probably be
mind.
right, that's the thing.
Tariffs. But yes, tariffs is something that is going to be relevant for HP as well. So that's also something that potentially, even if it didn't weigh yet, it's something definitely that the company is going to have to be keeping an eye on. So that's all going to be part of the discussion with Enrique Lores, because you can head over to the Yahoo Finance website later today. Our own Brian Sozzi is going to be talking to the HP CEO Enrique Lores at 6 p.m. Eastern. Keep an eye out for that.
Time now for what to watch Friday, February 28th. We're going to start off on the economy, a key piece of economic data coming out in the morning with PCE, that's personal consumption expenditures. Economists forecast that the Fed's preferred inflation gauge for January will hold steady for total PCE at 0.3%, and core PCE will tick up slightly to 0.3%.
Moving over to the Fed, we'll be getting more Fed commentary from Presidents Tom Barkin and Austin Goolsbee throughout the day. And it comes after comments from Atlanta Fed President Raphael Bostic yesterday. Bostic saying that interest rates need to stay in restrictive territory and continue putting downward pressure on inflation.
And taking a look at earnings, no rest for the weary this season. Some more reporting coming out from Fubo and TeraWulf in the morning. Fubo announcing results for the fourth quarter before the opening bell. Analysts expecting a 9% increase in revenue year over year. And we'll listen closely for any commentary on the company's potential deal with Disney.
That'll do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.
But don't go anywhere. On the other side of the break, it's asking for a trend. We've got you covered for the next half hour with the latest and greatest market-moving stories so you can get ahead of the themes affecting your money. Stay tuned.